The Fed raised the Fed funds rate by 25 basis points today. What does this mean for the banking sector, the economy, and your investments? Breaking this down with us is Danielle DiMartino Booth, CEO of Quill Intelligence. She's the author of a book called Fed Up, an insider's take on why the Federal Reserve is bad for America. And indeed, Danielle is a Fed insider, having worked at the Federal Reserve as an advisor to the president of the Federal Reserve Bank of Dallas. Welcome to my new show, Danielle. A pleasure to host you today.
And thank you for having me.
All right, let's start with my first loaded question. There's rhetoric from economists over the last year that the Federal Reserve will not stop raising interest rates until something breaks. Has something broken yet?
Well, I would like to think that that three bank runs in the United States, or three failed institutions in the United States, and losing one of the world's 30th largest financial institutions, Credit Suisse, would be a breakage.
Right. It seems to me like this breakage, though, has a plug in it. Janet Yellen, earlier this week, has announced, basically, I'm paraphrasing here, but she's announced that the government will support banks and bail them out if another Silicon Valley bank happens. So all is well?
Well, it certainly sounds like it, but the legality of the unilateral decision-making is beginning to come into question here. We don't know how long or how much the Treasury Secretary is going to be able to do. There are obviously some members of Congress who have begun to raise their hands and say, I think you've actually overstepped your bounds here. And I think we'll be hearing a lot more of that, especially given that every single congressperson, every single senator, they've got people, they've got constituents who are going to be on one or the other side of whether or not this is a quote unquote bailout. So I think that the politics of the moment will become a little bit less convenient for Treasury Secretary Yellen going forward.
I want to come back to the Fed and their meeting decision today. But while we're on this topic, you wrote in a note last night that your note said that it appears Yellen is playing her answer to hardball. The First Republic rescue was not going according to plan, as newswires flashed that it would not go through without U.S. government backing. Interestingly, I was reading an article that came out from Bloomberg this morning, and it said that according to Wall Street analysts, the bank has created a capital gap of as much as $13.5 billion, which is a sum that may explain why no savior appears to have stepped forward, were their colorful words. So, what can the government do at this point if another bank the size of First Republic Bank fails? Keeping in mind they're not even, one of the largest banks in America.
They're not, but by the same token, it looks like they've tried and failed. First Republic looks like it has tried and failed, echoing Silicon Valley to raise capital. It also appears today on the wires that PacWest is also trying and failing to raise capital. So this gets to the crux of the matter. This is what set off the panic when Silicon Valley first went. It's because that day they went into the markets to try to raise capital and failed to do so. You start to ask yourself, why won't anybody come to the rescue? Why can't you raise capital? When Chair Powell was just at the podium telling us how very strong the capital base was of the U.S. banking sector. If that's the case, why can't they raise capital?
Yeah, this seems like Groundhog Day. We've seen this before. Where have we seen this? Wasn't Dodd-Frank supposed to fix all this and prevent this from happening?
It was, but when you think about people like Greg Becker, who successfully, the former CEO of Silicon Valley Bank, who successfully lobbied Congress in 2015 to relax the requirements. He was approaching a $50 billion threshold, and he said, no, let's raise it up to $250 billion. So that we can keep growing the community, we can keep lending, we can keep serving our purpose and being good corporate citizens. And he was able to successfully lift that ceiling such that had he passed 50 before the lobbying and the laws changed, he would have been under greater scrutiny. This probably would have never happened. But the lobbying succeeded, and they raised that ceiling to $250 billion. And so what we're finding out right now, and the reason that Congress is having Vice Chair Barr of the Fed up in front of Congress next week to do some explaining, obviously the gap between $50 billion and $250 billion was just too big.
So how do you see this banking crisis unfold? Difficult to predict. Yeah, but yeah.
I have absolutely no idea. I mean,
Fair answer.
Look, in 2008, 2009, some of the biggest banks in America did the bidding of Washington, D.C. They came in and played the role of white knight, and they made some really bad purchases. And the banking community, the biggest banks, have long memories. So they're refusing to step up right now, even with the Signature Bank of New York. Even in that particular case, the bank doing the acquiring left most of the loan book with the government, essentially, and refused to buy any of that commercial real estate book. I don't blame them. But if you're picking and choosing, that's easy enough to do. But what happens if entire banks continue to go? And that's the real question here, I think, that regulators are struggling with.
Okay, well, you are the Fed whisperer, so help us decipher what Jerome Powell means by this particular statement. He said,
as a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate.
This came out of this meeting earlier this afternoon. What does he mean by that? Firming, raising rates, how many?
Oh, I've got your answer. It looks like they're done raising interest rates, which I have been contending for months is no longer really the focus of Fed policymakers. They want for the additional firming. They want for the balance sheet to continue to unwind. They want for quantitative tightening to continue pulling liquidity out of the system. And as long as all they do is pause, then just by virtue of staying in a steady, in a static, at a static pace of rolling the balance sheet off, that's considered to be continued tightening. And I think that is exactly what he was speaking to. The market has been saying, no, we need QE, we need zero interest rate policy. He's trying to say, not only are you not going to get zero interest rate policy, we actually said that in the dot plot, it actually says that the terminal rate at the end of 2024 has increased from 4.1% to 4.3%. In other words, it's going to be higher for longer than you even think.
So they're going to pause for now, but in 2024, perhaps another rate hike? Is that your expectation?
No, they anticipate 3 rate cuts in 2024. But again, and that's from the dot plot. But again, they also think, or they're also communicating that they're going to continue quantitative tightening in the background. Quantitative tightening is its own form of, it's a synthetic rate hike of sorts, because as we're sliding into a credit crisis, and that's been acknowledged, as we're sliding into a credit crisis, the Fed's going to continue taking liquidity out of the system by shrinking the size of its balance sheet. That's a form of tightening.
He said this to a reporter at the press conference a couple minutes ago. Somebody asked him, market participants are pricing in cuts for the rest of 2023. Is that something in the works? And Jerome Powell flat out said, no, we're not going to cut. I think that's pretty clear.
He has no intention of cutting. He has every intention. Again, David, that's why they increased where they see the Fed funds rate at the end of 2024, which I would remind you is a long ways away. So if they intend to, again, this is an experiment that's never been tried at home. The Fed has never been able to maintain tight policy ever. They've always gotten rates up to a certain threshold and then very quickly pivoted and started easing. That's not what's being described here. And he just said it at the podium.
Is that enough to bring inflation down to their 2% target, assuming that's still their target?
Oh, that'll bring it down pretty quickly. In the middle of tightening credit standards, the likes of which we haven't seen since 2008, it'll bring inflation down fast.
Yeah, he's being aided by, I guess, the monster he created himself, if you want to put it that way. Now, he also said that the labor market still needs to soften before a pivot, a flat-out pivot. We know that economic data is lagging. My question to you, Danielle, is once the labor market softens on paper, is that a little bit too late? Help us weigh the pros and cons of perhaps a straight-out pivot that's premature versus a pivot that's too late.
So to your point, yes, the unemployment rate is the most lagging of all economic indicators. In fact, the Federal Reserve today lowered its unemployment rate target for 2023 from 4.6% to 4.5%. So they're actually communicating to you that they see the labor market as being a little bit stronger than they did the last time they put these dots on this plot. But to the point of how lagged that is and what a mistake it is to necessarily follow that type of data, at Quill, we've been tracking every single week jobless claims. And as of the latest week, there are 67% of U.S. states have rising initial jobless claims. That encompasses 83% of the U.S. population living in a state with rising jobless claims. So if you look at other types of data, we can see unequivocally that the labor market's already turned.
I'm curious as to how corporate America is going to survive not just more rate hikes, but the rates at current levels for a sustained period of time, like you were saying. I'm looking at the amount of corporate debt. According to the St. Louis Fed, non-financial corporate business debt securities currently sits at $12.7 trillion, the highest in nominal terms on record in history. What happens when businesses need to refinance at higher rates later this year, or perhaps next year?
Well, nothing really pretty happens at all. And that's going to be a big problem. What is happening of a much more immediate sense is some estimates put it around $400 billion of commercial real estate debt that's got to be refinanced this year, and at much, much higher interest rates. And I think that is, I had mentioned what they refused to buy from Signature Bank, and that was their commercial real estate loan portfolio. So that is going to become front and center, and something I dare say that Powell will have a very hard time ignoring as we get into 2023 and this credit crisis deepens.
And what about on the consumer side? Do you think consumers can afford this latest round of hikes? It's only been, it's only 25 basis points. But do you foresee delinquencies on loans, perhaps foreclosures on houses later in the year, or perhaps 25 basis points is all right, not that big of a difference from where we were before?
Well, it's not that it's not that big of a difference. It's that we're seeing auto repossessions running at the highest level since 2019. We're coming into a time of really battening down the hatches in terms of tightening lending conditions for households, whether you're talking about a mortgage, a refinancing, an auto loan, credit card, you name it. So lenders are really clamping down standards. Some lenders are just flat out exiting the entire business of making loans. They're saying we're going to put a pause on this for the next 6 months. So that is going to be very harmful for the U.S. household sector, because its lifeblood is constant generation of fresh credit.
Okay. You were tweeting this post that you made a while ago, and I'll just read this tweet. I invite you in today with my client's blessings. We live in troubled times. The sin of ZERP and QE are presumed to be otherworldly free lunch. And in this article that you wrote on Substack entitled "Too Small to Not Fail: A Short History of the World," I encourage everyone to read this. I'll put a link in the description down below. Summarize your findings for us. Yeah.
It's free. That's the point. I've never really taken the paywall down like this before. That's how important I feel it is that people read this.
Right. Okay. Why is it so important that you let the world find out about your message right now? What are you trying to communicate?
So, I've never been Jay Powell's biggest fan, but by the same token, if he is hiding behind lagged unemployment rate data, if he's hiding behind lagged inflation data or job opening, and I use the word hiding purposely, if he's trying to actually sever the dependency of the financial markets on Fed policy, if he's trying to get back Fed independence, and that's what we're talking about here when it comes to quote unquote breaking the Fed put, if that's Chair Powell's goal, and he is knowingly hiding behind what he knows to be specious data, then maybe that is for the greater good. And maybe that gets us back to a place where we don't live in a world in which the U.S. economy can only subsist on zero interest rate policy and quantitative easing as constant states. And we have to bear in mind, since December 2008, when Bernanke took us down to the zero bound and launched quantitative easing, the economy has been in a very dependent state ever since then. And the two attempts at normalizing policy have failed.
It seems the Fed can do no right, nor can they do no wrong. Remember in the Volcker days when he raised interest rates to double digits? I wasn't alive back then. I presume there was a lot of protest, but Volcker did succeed in bringing down inflation. How do you think history will remember the Jay Powell days? He did start with zero interest rates, and now look where we are. Things haven't unfolded very well, but perhaps history will look back favorably at what he's done in his fight against inflation. I'm just speculating. Please disagree if you must.
Well, that's certainly how I end what I call my opus, and that is that if against all odds, and I'm the first to say the odds are stacked against Jay Powell to succeed, because the economy is very visibly in need of much lower interest rates and for quantitative easing to be resumed instead of quantitative tightening. It's ugly stepsister. If he succeeds, however, in normalizing interest rates, and maybe as we head into recession, only has to take the Fed funds rate down to 2%, and recognizes the fatally flawed logic of Ben Bernanke that we had to take interest rates down to the zero bound, where it's almost impossible to escape from that level. If he's able to put monetary policy on a more normal footing, then he will be remembered favorably.
Right. Final point on your opus here. You've made I'm just looking at it right now. You've gone into extensive detail on the U.S. banking sector and its history and what's been happening. One particular paragraph stood out to me. You have a chart called "The Demise of U.S. Community Banking." Very strong words, Danielle. And it shows the number of U.S. FDIC-insured commercial banks having come down over the last 20 years. First of all, why do you think this trend happened? And what do you think the future of banking in America will look like following this crisis that we're seeing right now?
Well, sadly enough, going into the great financial crisis, small community banks held 55% of all commercial real estate loans. Today, that number's 70%. So they're overly exposed to commercial real estate loans. That's going to put them on very weak footing. It's not the fault of their own that they went down that path. That was because of how poorly constructed Dodd-Frank was coming out of the crisis. And on top of that, they have less of a cushion in terms of the coverage that they have for their uninsured deposits, which is very problematic in this high interest rate environment. And that is why there are calls for Janet Yellen to backstop the uninsured deposits of all banks. But I dare say that the community banking structure of the United States, even though people say we're overbanked, we have too many, I'm sorry, but Bank of America, JP Morgan Chase, Citi, they're not going to open a branch in every town that's left without a bank in America. And that has always been a backbone of the U.S. lending community. And it's been a very strong one and a unique aspect of our democracy. So to see that more at risk than it's ever been is quite unsettling.
Just a quick note on that. The proponents of cryptocurrencies and DeFi are celebrating this development, as they say this is now leading the way into a mass adoption of decentralized finance products. Instead of going to a regional bank, you can now bank on your phone using a wallet or a decentralized exchange. Is this the future?
Well, I doubt that very seriously, even though there have been a lot of proponents pushing people into the crypto space since this has happened. I suspect the same people who've been the Pied Pipers are going to be the ones who take their profits off the table first.
Okay. Finally, I want to get your outlook on the economy. The yield curve has been inverted since July 2022. Usually in the past, not always, but usually in the past, a 6-month period of inversion has led to a recession. Now, the NBER, the National Bureau of Economic Research, which is the organization that designates recession, hasn't officially done so yet. Are we overdue for one, or is this just not happening because it's already been more than 6 months?
Well, the problem I do not envy the people at the NBER, because when you get to the crux of GDP, which is business investment plus household consumption, adjusted for inflation, that that inflation adjusted figure has been 17.7 trillion since the first quarter of 2022. It ain't moved. So the US economy has been stagnant, if you will, since January of 2022. It makes the NBER's job really, really difficult. And you've also had the United States become a great exporting nation of natural gas and other idiosyncrasies that have pumped up GDP growth that make it that much more difficult to be on the NBER and be the one who has to designate U.S. recession. Don't envy them.
Definitely tough job indeed. And finally, investment implications of everything we've discussed today.
Well, obviously, we've got another 25 basis point increase in very short-term rates. So those cash holdings look even better today than they did yesterday. And for that matter, for all of the enthusiasm surrounding Bitcoin, somewhere in the background, gold and silver have been rocking it. And they always do in times of financial crises, whether it's deflationary or inflationary pressures that are building.
Great. Well, thank you for joining me today, Danielle, and pleasure to speak with you. As always, where can people find out more about your work? I believe the Quill Intelligence now has moved to a Substack.
Yes, the Daily Feather itself has moved over to the Substack platform, DiMartinoBooth.substack.com. Love to have you come on as a subscriber, and you can also come on and be a free subscriber and just look from the outside in and see what we're writing about on a daily basis.
Okay, I'll put the link in the description down below, and I'll put a link to the opus that you just wrote about the banking crisis and the current macro environment. Great read. Everybody should check it out. Thank you again, Danielle. Appreciate your time.
Thank you. Take care.